All right, guys, so we have a lot happening today here in the markets. You had Fed Jerome Powell that did speak, and he was nominated to serve another 4 years as the Federal Reserve Chair. On top of that, you have the Snapchat dilemma, which is absolutely destroying your portfolios. The SPY, the S&P 500, this is the ETF for that, it is down 1.22% today. The NASDAQ is down even more than that today, down about 2.5%. Russell 2000 down 2.18%. So let's talk about all of this information. I really want to highlight the Fed because we have another big Fed catalyst coming tomorrow, and that is going to be the FOMC minutes, and that's going to be a much bigger market moving catalyst. Even though Fed Jerome Powell today did cause the markets to start to go up, the NASDAQ was down about 3.5% at the lows today, and the S&P was down well over 2%. So all in all, Fed Powell today was bullish, but not too many headlines actually came out of it. But the big one is going to be tomorrow during the FOMC minutes report that comes out at 2 p.m. So let's get into all of this information. I want to talk about what's going on with AMC as well, talk about the option activity, all of that. So hit that like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. Thank you guys for tuning in, and let's get straight to it. So as you guys do know, we had the Snapchat debacle that came out in after hours yesterday. And it's not the fact that Snapchat is like a huge stock for the market. It's a mid cap. It's a $40 billion, give or take, market cap company. So it's not in terms of like this is shocking news like an Apple that is 7% of the S&P or 13% of the NASDAQ. Snapchat's not in that same realm. But what they said is not good and can have wider reaching effects, not only on social media stocks, but they're basically saying that advertisers are slowing down. If advertisers are slowing down in a very dramatic way, in the last month, you got to cut your guidance even lower than the low end range of your guidance you set a month ago. That is not showing a good trend. And when advertisers are not advertising as much, it's not good for, okay, what's happening to their underlying business? That can't be looking good as well. So that's really the big fear, and that's why you're seeing a lot of your portfolios actually selling off into the ground today. But these opportunities to buy the dip over a prolonged period of time do not happen all too often. And if you are somebody that dollar cost averages into the market on a set schedule, whatever the case is, it is very important that you do continue to do that same strategy here, because that is what is going to make your returns exponential on the back end of this. And if you can, you should probably be investing a little bit more during this downward time frame. There's a lot of stocks with massive discounts out there. Now, let's talk about Fed Jerome Powell and what actually came out of that today. Well, we have a couple headlines. Fed Powell sworn in for second term as U.S. Fed chief, but he says 2 hours ago, a soft economic landing may be out of Fed's control. And that's the biggest issue that I see right now, and kind of why I think the Fed will have to stop raising rates here over the next 3 to 6 months, no matter what happens with inflation. Hear me out on this, because the Fed doesn't realize this right now, which they've said that, you know, they understand they can't do anything for supply chains, for oil, for food prices, but they don't fully understand that inflation and what is really hurting the economy is oil, gasoline, right? Energy and food. Take those two things out the equation, inflation is not that bad. People would be able to do just fine if, you know, your gas prices weren't as high or your food prices weren't as high. And these are really factors that could last a long time. If the war in Ukraine does drag out for a long time, you're talking years possibly. And the food situation is going to last years as well. Food in general, it takes time to grow. So people are not planting as much right now. You can't expect to have normal, food markets again, at least until the second half of 2023. And the longer that goes, the longer oil actually stays above $100 a barrel, the higher and higher chances you have of seeing a very large recession. I was actually talking about this extensively on the live stream last night, but when you look at the oil markets, every time we have went over $100 a barrel, we have went into a recession. And if you look at the history of oil, we've only been over $100 a barrel for oil really for about 3 months during 2008. We have been over $100 a barrel since the start of 2022. So you're already at 5 months. If this stays over $100 a barrel or still just elevated overall for, call it, another 6 months, you're going to be in a pretty bad recession. And the Fed at this point would just be adding fuel to the fire. They wouldn't be helping the inflation problem. They would be hurting the economy even more. And the Fed doesn't want to hurt the economy unless there is some kind of benefit like getting inflation down. But I think it's going to come a time here in the next 3 to 6 months where they will realize, hey, we're just hurting the economy. We're not helping the problem. We're not helping working families. So we might need to hold off on raising rates as aggressively. And that, I think, is the most likely outcome here. You even had Fed Wallard that came out and said, yeah, we favor doing, more rate hikes or larger rate hikes than 50 basis points. But, he said that we should probably stop raising rates around September because maybe he sees what I'm telling you guys. It's pretty straightforward and it's written on the walls at this point, but it'll become more obvious, especially to the Fed over, the next couple of months. The situation with energy this high, something the Fed cannot control, is really, really bad, and it could be a major problem for the economy, and it could cause the economy to go into a downturn for years. The price of energy affects everything. If you're a business, you are affected by the price of energy to some extent. Even if you're a restaurant and you use zero energy, well, if gas prices are super high, not as many people are going to go out to eat, right? If you're an Amazon, obviously, that is chipping away at your margins, right? If you're a Walmart, that's also chipping away at your margins. Basically, any business, you can add some degree of cost due to energy, no matter what kind of business it is, no matter if you use the product directly or it's just, secondhand nature, right? You get deliveries with people that, drive. So, and that's every business. So it's a big problem overall, and I think this is the largest risk to the economy at the current moment. We don't have that systemic risk, though, yet. We don't have bankruptcies. We don't have banks going under. You don't have things like that, but the longer the energy situation goes, potentially the more bankruptcies you will actually start to see. I believe it's every dollar a barrel of oil goes up, it costs the economy like $20 billion of GDP, or people have to switch their money. They don't have as much money to go buy other things. Every dollar that barrel of oil does go up, so not good. Not good. I hope you guys are catching my drift on that. But like I said, this is the buying opportunity to load up on all your favorite stocks for the next 3 to 10 years, and hopefully we do stay down for quite a while, so we all have a lot of time to really build out our core positions and to really grow our wealth on the back end of this. That is the very exciting part. Now, as far as AMC stock in particular, let's take a look at the short interest. That is sitting at 22.57%. Current short interest off your float, current shares that are sold short of 116.34 million. Cost bar max at about 5.84%. The utilization is 100%, and the days cover sitting at 3.32. Shares out on loan 163.41 million. So you haven't seen too many shares that have actually been sold short over the last day or two, but you have seen a lot of shares actually go out on loan, and now the free flow out on loan is 31.70%. So there's a lot of potential shorting power, lots of shares out there that could short the stock. And that's probably why you're seeing the utilization staying at 100%, because even though they're not necessarily borrowing these shares and instantly shorting them, they're still borrowing them, and that is taking away from the overall float. So that's probably why you see the utilization at 100%. And you're probably seeing a lot of shorting actually happening today. You're looking at 4.34 million shares that are being borrowed today, 1.45 million shares that are being returned, borrow change of 2.89 million. I would believe, AMC stock to fall 9% right now, you probably have a lot of shorting that is going on. That's not even to mention the option activity, which does look increasingly bearish today. These hedge funds are flipping back and forth like nobody's business. And when they do buy options, they tend to buy options with a very close break even. So if the stock falls like 9%, you see a lot of market makers shorting that has to happen just to oblige for the put options on the option chain. So that is that. The situation still does look primed. In my opinion, I do think over the next coming weeks, you're possibly going to see the MOAS. It all comes down to the executive order, comes down to the state of liquidity in the markets. It's a lot harder now to service a margin call with or without using Chinese securities as collateral. But like we've seen in January and in June, that's actually a very big deal for hedge funds when they can no longer use Chinese securities as collateral. That has triggered two of the short squeeze, gamma squeeze rallies we have seen in the past. So I do think, just boiling it down to that alone and looking at the overall economic conditions, you can be fairly confident of a rally is likely to come. And we have seen a lot of bullish activity in the option markets over the past week, even though we're only looking at 2 orders totaling $500,000 for the day and 0 positive order value. Yesterday, we had 5 orders totaling $519,52,000, positive order value of 88%. Over the past week, $29.54 million worth of orders, 79 orders totaling almost 30 million, positive order value of 91% over the last week. The last time we've seen this kind of option activity was before 2 Fed meetings ago and before the stock went up about 200%. So I do think that we are going to see a rally, but given what we see today, it's basically a green light to go out and short stocks. Snapchat just killed everything. So that is that. If we're looking at the technicals, you want to see if we stay above $10 per share. It looks like we will. It looks like if there was a day to go under 10, it was probably going to be today. The FOMC minutes tomorrow could freak people out just because what could be said during the minutes. But I think a lot is priced into the markets, and specifically AMC is trading at like a 1 price to sales ratio, right? So it's not expensive on a overall like book valuation. Not expensive at all. So you're really not buying any of the fluff here. If you're buying AMC stock, you're really buying it for the potential momentum. At this point, you're not really buying, the meme stock status. It has no extra premium because of that. So that is obviously a good thing and a good reason to be buying the dip on AMC stock. The RSI is heading into extremely oversold territory at 32.45. Oversold is 30. So we are right there. And the MACD is actually pretty neutral after this up and down movement we have seen over the past couple of weeks. So that is going to be all for this video. Hit that like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time, link down below in the pinned comment. Thank you guys for watching, and I will see you in the next one.